Hello and welcome back to another episode of Darwin Investors. We finally had a good week last week. That's first in a while. I guess about the first time in 8 weeks. I guess the longest losing streak since 1923 for the Dow Jones. That was a tough year. I remember it well. So what we're going to do is we're going to talk about what happened in the market this week. And we went on quite the roller coaster ride. Sometimes the Dow was up and the NASDAQ was down at the same time. Crypto was always just kind of down. And we're going to talk about some of the earnings that went on last week that caused this to happen in the market. And we're also going to talk a little bit about the events that happened last week that caused this to happen to the market. So there's a lot to unpack this week. So let's go ahead and I'll share my screen and we'll get right into this. So Market Watch came out with this article last week called Retirement Weekly. And the title of it is Watch Out If You're Male Over 45 and Think You Know About Investing. According to this article, I'm in trouble. And it says that some investors are more likely to freak out and sell during a decline. And they weren't just kind of like flippantly just throwing this information out there, but rather that it was actually extrapolated through a pretty large data set. So for the study, the authors were given access to a data set consisting of more than 650,000 individual brokerage accounts between 2003 and 2015. And the way that they were defining panic selling is it said panic selling occurs when an investor intentionally sells off a substantial portion of their risky assets abruptly. And the researchers specifically define it as a decline of 90% of a household's equity assets over the course of 1 month, of which 50% or more is due to the trades. So who was most likely to do this? Well, what they found is that people over 45 have a heightened tendency to make panic sells, whereas younger investors are less likely to make panic sells, and that's by a wide margin. People who are married or divorced are more likely than other groups to freak out. So I guess never married would be the least likely to sell out. So young, never married. Males slightly more likely than females to panic sell. If you have dependents, you're more likely to panic sell than people with no dependents. If you have investing experience, now this one I think is kind of interesting. It's those people that say, I was around in 2008 and 2009 and 1923 when the Dow Jones was down more than 8 weeks in a row. So these people are more likely to panic sell because they think through their own experience, they know when to get in and get out and that sort of thing. And people that have knowledge in it. They also believe, similar to the people with the experience, they think, well, I know best. I know what's going on in the macroeconomic arena and that sort of thing. So I know when to get in and get out best. So these are the people most likely to panic sell. And it makes sense, you know. No researchers attempt to give an answer as to why this happened, but this article did. It says, if I were to speculate, I'd bet that a psychological tendency to panic plays a big role. So people who generally panic would panic in this case. That would be one. But it also seems plausible that this tendency is more pronounced among investors who are older and therefore have less time before retirement, before their portfolios to recover from a bear market. And it also could be stronger among those who have others beside themselves to support financially. All of this makes sense. So why wouldn't you want to just get in and get out of the market? Well, this article shows it has a chart which shows why investors should never try to time the stock market. And this chart shows that if you were to exclude the 10 best days per decade from the S&P 500 since 1930, you would be up 28% since 1930 on the S&P. If you were to exclude the 10 worst days per decade since 1930, you'd be up almost 3.8 million%. And if you were to include both, you would be up 27,000%. Well, you might look at this chart and think, okay, well, no problem. All I have to do is exclude the 10 worst days and I'll be up over 3 million%. Well, yeah, in theory, that's great. If you're able to figure out the 10 worst days every single year, well, you're different than everybody else on the planet. I think by and large, we're going to sell out and we're going to miss out on these 10 best days, which usually follow some of the worst days. And we're going to end up only up about 28% instead of being up the 27,000%. by staying in. And I'm not just saying like stay in stocks that you think are maybe not very good trades. You can at least gauge the climate of the market. Like right now, it's not a good time to be in high risk assets, speculative stocks, no price to earnings ratios. This is not a good time for those right now. So you may want to move your money, but you may not want to move it all the way out. We'll talk about what I plan on doing if we do get this ripper rally that some analysts are expecting us to have in the month of June, how I'm going to juggle my money. But really what I'm going to do is I'm just going to return it to the way that it always was. I never meant to be all in like I am right now. It actually, I'm a little bit on margin. And so what I like to do is usually hold about 30% cash, and then I use that 30%. That's still in the market, but it's kind of like my gambling money, if you will. Stuff I try and get in, get out, make quick money, and that sort of thing, while I leave just 70% wholly invested. But right now I'm all the way in because the market crashed while I had my money in on, I think it was JP Morgan. So let's talk about some of the events that happened last week that caused the stock market to do just really wild things. Everybody's just kind of on edge. I don't think that retail investors know what to do. I don't think that hedge funds know what to do. There's an awful lot of gambling going on out there right now, I believe, on behalf of the hedge funds. I have a video, I'll link it in the description, that happened last week, the sorts of things they're doing. They're essentially just short selling a lot of stocks right before earnings, buying puts, and then keeping their fingers crossed that everything goes their way. Sometimes it does and sometimes it doesn't. I'll give you a couple instances here that happened last week where it went their way, or one where it went their way and one where it didn't go their way. So on Monday, Snapchat, they didn't even report earnings, but Evan Spiegel, their CEO, came out and said that the company is going to miss revenue. So they just reported last month, and they're saying that we're sorry, we goofed. Our guidance was no good. We're going to miss revenue and earnings, and we're going to stop our hiring. It's because essentially what's happened here in the past month, the market, well, not the market, but the economy and the market has taken kind of a bit of a sudden downturn. It just suddenly feels like things are a little bit worse here in May than they were in March. And they didn't feel great in March, but there has been a sudden downturn. Talking about less like a slowdown in housing, slowdown in hiring, CEOs giving bad guidance. A lot of these companies are reporting earnings and giving poor guidance. And so because of this, Snapchat didn't just go down, but it took down like all of tech with it, as weird it would sound. It was like, oh, Snapchat's going down? Well, that must mean Google, we got to sell all that, got to sell all of our Apple. But it shouldn't have done it, but it did. And it was interesting because at that very same day, at the very same time, you see, we got Monday, May 23rd. On that day, you've also got Jamie Dimon coming out saying that they're on target for a 17% return on tangible common equity. That was their target before they turned it back at their earnings, and now they said we're going to go back to 17%. That's what we are going to hit that, because things look pretty good. That's a switch from earlier this year when CFO Jeremy Barnum warned that headwinds, including rising costs, would cause the bank to miss its targets for the next 1 to 2 years. Jamie Dimon came out and said, no, that's not true. And because of that, the shares rose 6.2%. It actually lifted the whole entire stock market. So now we had a situation where Snapchat was crushing the NASDAQ and JP Morgan was raising the rest of the stock market, anything other than tech. Because this is not 2008 where Bear Stearns and Lehman Brothers are going out of business. The banks are in good shape, and they just came out and said this. And so when we look at last Monday, we can see on Monday, the NASDAQ, after its news with Snapchat, went down 406 points or 3.5%. And then on Monday, the Dow Jones, it went up 489 points or 1.56%. So there was quite the split there based on whatever stocks you were in. Snapchat caused all the tech stocks to sell off, and JP Morgan caused all other stocks to be, it was time to buy. Also, on that day, Walmart, Ross Stores, and TJX pushed higher. The retail trade there went higher, and I always think this is really interesting. TJ Maxx went up 5%, Ross went up 10%, even as Target and Walmart sold off last week. And I think it's weird that these stores would go up when Target goes down, because their business model is basically to take whatever Target can't sell, they then buy up other retailers' unsellable merchandise, if you will, and try to sell it themselves. I would think if it isn't going to sell at Target, why would it sell at Ross? Maybe it's because they're marking it way down. Don't really know. But that might be the reason why it sells, because we'll see that later on in the week what happened with Dollar General and Dollar Tree, that discount retailers have an expanding customer base. Let's put it that way. And you can see that TJ Maxx, after Target reported earnings, TJ Maxx went up 9.29%. They were like, "Oh wow, Target's really having a bad day. Let's have TJ Maxx go up 10%." Some of these things didn't make sense, but it made sense to someone, I guess. And then on Tuesday, Best Buy, they released their earnings, and now these were rotten earnings, in my opinion. I have no idea why the stock on these earnings would pop, what is this, 10%. Listen to what their earnings were. They said they beat their expectation. They said the same store sales fell by 8% versus the 8.6% drop analysts projected. So here's how the retailer did in the past 3-month period ending April 30th compared with what Wall Street was anticipating. Earnings per share were $1.57 versus the $1.61 expected. They missed. They lost 8% year over year. The revenue was a slight beat, $10.65 billion over $10.41 billion. And their guidance said they were guiding down. They said their full year guide is now between 48.3 and 49.9 billion versus 49.3 and 50.8 expected. So they guided down, their earnings missed, they're down 8% year over year. Why would this stock pop 10% on this news? It's the thing that I explained in my last video about how companies are short selling and then they're buying puts. They're getting squeezed up. Like all it takes is some other bank to just buy it up like crazy, and then they have to cover their short positions, driving these companies upward. And in the case of whoever did this to whoever shorted Best Buy, and it seemed like a great stock to short, by the way, at the time. Because what did Target say they were having trouble selling? Electronics. What did Walmart say they were having trouble selling? Electronics. And so what do these guys sell? Electronics. So the logical move was to short sell this thing, but some other bigger bank or some bigger seller was like, "We'll get you. We know you're going to be out there. We're going to buy it like crazy, and we're going to short squeeze you until this thing's up 10%. And that seems to be exactly what's happened. So what is selling over at Target and Walmart? Well, it's groceries. That's what's holding up the market. But one of the things that's squeezing Target and Walmart that they're pretty upset about is that the people that are, they have no margins anymore. And so their margins are getting squeezed. And why are they getting squeezed? Well, one is labor, but two is shipping and supply chains. So they're looking at their shippers going, why, people like UPS and like FedEx and what have you, saying why, or even any of the shipping companies, really, it could be, what is that, XPO, logistics, whatever it is. Why are you guys having such good margins and we're getting screwed here? And so these are things that they're going to squeeze the margins of other shipping companies to make sure that their margins are okay. That's kind of what I predict is going to happen for some of these big box retailers. They're going to make sure that they spread the wealth a little bit. It's the same thing that's happening right now with gasoline. It's like, why is it if oil prices are stable or coming down that the price of a gallon of gas keeps going up? It's because your refiners, your Valeros, your Phillips 66s, and that sort of thing, they're gouging America. Now the politicians are only going to allow this to go so far because their geese are cooked if they allow this to spiral too far out of control. So there's going to be some political pressure to make sure that these refiners don't have the huge profit margins that they've suddenly found themselves falling into. So these are things that I expect that would probably contract a little bit. I would expect your refiners to contract a little bit. I would expect your shipping companies to, not necessarily the shipping companies, actually, now I think about it, because they've already been compressed very, very big. You know, logistics trade has been hit so hard this year. I'm not so sure how much they have to go. I mean, already these shippers are trading at historically low price to earnings ratios. So I don't know how much more there is to contract there, but I would probably look for some of the refiners to probably pull in just a bit. Then on Wednesday, Toll Brothers reported, and they found that their quarter was way better than expected. it turns out that people with money are still willing to spend money. Toll Brothers is a high-end home builder. Their average home price is something over $900,000 a home. And so looking ahead, the company is expected to deliver 11,000 to 11.5 thousand units and compared with 11.25 to 12K in the previous forecast. It also sees average delivered price per home between 890 to 910,000 versus 875 to 895 in that was forecast before. Its adjusted Q2 EPS was $1.85. That Wall Street only estimated they make $1.60. That is a jump from $1.01 per share a year ago. Revenue at $2.2 billion also exceeded consensus of $2.12 billion. I guess the take home from this is that Toll Brothers is doing very well, thank you very much. And the reason why is because the people that buy these homes aren't necessarily the people that are getting impacted that much by inflation. And if it wasn't enough that the banks are showing that they have really good economic health in the future now and in the future, and that home builders, at least the ones that are building high-end homes, are doing just fine, and that the electronics or the consumer or the retail business apparently is not doing as bad as people think it's doing, well, then the Congressional Budget Office here, they released a forecast on the 25th of May where they estimate that the real gross domestic product will grow 3.1% in 2022. They also said that inflation has topped and will cool to 2% by 2024. This was enough to send the market going even higher. They're like, wow, we're doing a lot better than we thought. And this was on the 25th. And then on the 26th, the FOMC came out and they didn't give any surprises. These were things we already knew. So on Wednesday, the 25th, Fed minutes point to more rate hikes that go further than the market anticipates. Now, on the surface, that sounds like something that's really terrible, but let's see what this really means. What they said is that they're going to do multiple 50 basis point interest rate increases. We knew this already. This is not a surprise to anybody. The thing that might have scared people was that the FOMC said that policy may have to move past neutral and into restrictive territory. So what does moving past neutral means? Well, the neutral rate is the theoretical federal funds rate at which the stance of Federal Reserve monetary policy is neither accommodative nor restrictive. In short, real interest rates consist with the economy maintaining full employment with associated price stability. So they're saying that we're going to raise these rates. We hope that unemployment doesn't go up, or if it does go up a little bit, I think that we can take it. And the reason why we can take it is because the members of the Fed believe they can bring down inflation, but they are a little bit concerned about financial stability risk because the Fed has the two jobs, maintain low unemployment and keep inflation down. But then the next day, what happened was there was a correction to the last GDP print. This happened on Thursday. And what they found is that the GDP was a little worse than thought. Instead of 1.4%, it was 1.5%, but jobless claims edged lower. So that's going to give the Fed even more confidence to raise interest rates because the unemployment rate just keeps shrinking. So if they have to tighten a little bit more and essentially when you're raising these rates, you're kind of saving for a rainy day. But if they have to tighten a bit more and drive the inflation down, they think that the job market can actually take that. So this was actually looked at as good news. So we had the CBO giving us good news. We had the Fed through the FOMC minutes not giving us any surprises. We had the following day when they released this publication about the economy and the last GDP report that the jobless claims edged even lower. So for all of these reasons, the market liked all of this. And then also on Thursday, this weird thing happened where NVIDIA stock fell 9% on this report. It's shocking. So here are the most important numbers from the report compared to what Wall Street was expecting from the graphics card giant in the quarter. Revenue was 8.29 billion versus the 8.1 billion expected, a beat. Adjusted EPS was 1.36 versus the $1.29 expected, a beat. The revenue is actually up 84% year over year, incredible. Data center up 3.75 billion versus 3.63 billion expected, a beat. Gaming 3.62 billion versus 3.53 billion expected, a beat. And so why would it that they would go down? Let's say, well, the company says it sees $8.1 billion in the upcoming quarter. So they had what they called a weak guide. Wall Street was saying we wanted 8.44. You know what? Who cares? Because to me, the biggest takeaway is right here, is that their data center revenue was more than their gaming revenue. So when you look at like years past, here was FY21 versus 22. Gaming has always been their biggest sector. Data center has finally passed it. And what that says to me is NVIDIA is an evolving company with a bright future, and that they're not just reliant upon the gaming sector. Now they're turning into a data center company, and soon they'll be turning into an autonomous driving company as they partner with people like Land Rover and Jaguar and that sort of thing. Lucid is actually one of their partners as well. And so they're so much more than just a chip company. They're so much more than just a gaming company. And anybody that says that's all they are anymore, I would probably not listen to them, because they kind of don't know what's going on. So why would this stock fall 9% after hours on this? Well, the reason why is because there were already short sellers there. They were already buying puts. They needed it to happen. But unfortunately for short sellers, that wasn't going to happen for them, because while they were able to push this down 9%, the very next day it was up, looks like 11.5%. So they were able to get a little bit of money if they got out soon, but basically their shorts got unwound and they ended up losing money on NVIDIA. And so that would be a reason why NVIDIA went down after making those great earnings. The same thing happened to Microsoft also. You know, they went straight down and bounced straight back up. A lot of these guys are playing this game, and it didn't work in this case, and thankfully it didn't. It didn't work in the case of Best Buy either, so that was good on them too. All right, and then also on Thursday, Dollar General and Dollar Tree earnings sent their stocks soaring. And so why would their stocks go up? Well, their stocks went up because they have an expanding customer base. Their shares rose 13.71% and 21.87% to close the day on Thursday. Now, they were down going into the earnings, so the pop doesn't look as impressive as it ended up being. But what's happening here now is, now that we're kind of looking at the economy as a whole, is people on that because of inflation that don't have a ton of money, that cohort is expanding. Dollar Tree and Dollar General is getting a larger customer base. Toll Brothers customer base is staying pretty steady. It's not shrinking either yet. I think it'll shrink eventually as mortgage rates go up. I can't imagine people are going to go off and buy all these homes. But right now it looks like people on the high end aren't getting squeezed, and the people on the low end are building a larger customer base. And the people that are kind of getting squeezed are those in the middle to me, that would be your Apples of the world. I think Apple could be just in a little bit of trouble in the short run. I don't know. We'll see. It seems like this whole world is kind of like a microcosm of my life, and I feel like of my account. Like I feel like for me, inflation hasn't been that bad because I own my own house. I don't need to get car loans. If I don't want to drive somewhere, say, I don't want to drive somewhere and there's all these gas prices are going through the roof. This is something I control. I don't have to drive to Florida. I live in New Jersey. I don't have to drive to Florida if I don't want to and pay $6 a gallon. As a matter of fact, a lot of people are making this choice because the demand for gasoline seems to be coming down a little bit year over year, whereas it is up over last year, 8.3%. Of that total, 4.6% of those drivers are supposed to be on the road during a 3-day weekend, but that's still down from 7.2% from 2019. So it looks like if you compare it to 2020, we're driving more, but if you compare it to 2019, we're driving less. And so you might ask yourself, what's the number that gas prices can get to before people stop buying more gasoline? Well, apparently that number is $6 a gallon. And the same thing could be, I don't need to buy a $50 burrito if I went to Davos, Switzerland. These are costs that you don't have to make right now. Like I said, I have my own house, and now traditionally my wife and I, we go through different houses and we try and, just the next better house. But right now, with mortgage rates going up 43%, don't necessarily, I feel like my house I'm in right now, I'm never going to get a deal this good again. My house is like appreciated, 35% in the past year. My interest rate is 2.5% lower than what it is currently. Why would I move? Of course, I say that to my wife, and she says, I say, why would I move? Why would we move? It doesn't make any sense. She says, yeah, you're right. I've always hated that kitchen. Let's remodel it. I'm like, dang, here I'm trying to save money. And then now she wants to take us over to Lowe's and Home Depot and remodel the kitchen. But that's the way people might be thinking here in the future. It might be people that have a little bit more are going to be doing a little bit more remodeling. If you look at 30-year fixed payments from 2020 to 2022, this would be on a house that has a $300,000 loan. We can see that in May of 2020, with a 3.26% rate, you were paying $1,307 a month. In May of 2021, $1,200, $1,250 a month with a 2.96% rate. And here this year, it's $1,660 a month, which is quite the increase over last year. And so we're locked in at a good rate, at a good price. We're far more likely to remodel than we are to move. And this sort of home demand might reflect a little bit more broadly across the market. Another thing that could be happening here going forth in the future, when I look at my little options portfolio, these are the covered calls that I've sold this week. So this is another way that I'm hoping, at least, or thinking that my life might be a little bit of microcosm of the market at large. So what I've done is I've sold 6 covered calls against certain equities that I hold. And so if you look at here, like say JP Morgan, if by June 3rd, JP Morgan is under $133, I get to keep the $43 that was given to me. But if it finishes above $133, say $135, I have to sell 100 shares of JP Morgan at $133. Right now, JP Morgan is trading at $131.27. So there's a little bit ways to go, but there's more to options than just the underlying stock price. There's also time to maturity and there's volatility. And for that, my $43 cost basis that I received is now worth $92. I can buy it back for $92, or I can just let it ride and sell these shares. Right now, I'm down $48 or 112% on my trade. If the day comes on, say, sometime this week where JP Morgan, and that sometime this week, probably like Friday, where I'm just really behind on it, I'll have the choice to either sell these stocks or I can roll the option. Rolling the option means that I can buy my way out of this contract for $92, maintain my shares, and try and sell another covered call on it again. Because let's say I don't want to sell it for $133 a share. Let's say now instead of $133, I say I want $136. So let's go over and see how I would do this. Now, I have bought it back for $92. Let's see what I can resell it for. Like we said earlier, these stocks come with intrinsic and extrinsic value. The intrinsic value is the value of the stock, $131.27, and the extrinsic value is the time to maturity and the volatility involved in the option. And usually with stocks like JP Morgan don't have a lot of volatility, but you give enough time, the volatility will spike out a bit and give you a little bit of money. Now remember, the one I had before expired this Friday at $133. We're going to move it out in time, June 24th, and up in price, $136. For this, I can get $1.77 a share, and each contract has 100 shares, and I would sell it to open, and I could sell it for $177. So I could buy it back for $92 and then roll it out in time and up in money and get $177 for this trade, net me another $85. And this might be something that I choose to do should I want to hold on to my JP Morgan shares. Not only that, but should it go up to 136 from 133, I'm also getting another $300 on my underlying. Covered call is a way that I actually do make a little bit of money while this market goes on, and I think that a lot of hedge funds are doing the same exact thing. And you can see since, let's see, over the past month, I've made $571, closing out a whole series of covered calls. You can see they're all calls. I haven't sold any puts. I'm not selling any puts because the market is just headed straight down. You buy puts when you think the market is going down. You sell puts when you think the market is going up. And since I'm only a seller of contracts, I sell calls and I sell puts when I think the market's going up. Now this market here has been going down, so I haven't been selling any puts. I've been selling covered calls to the tune of $571. Right now you can see on all of my trades here, all of my covered calls, I'm currently down $639. I can roll all of them if I feel like it. I can wait for a bad day next week. As been happening, let's say the NASDAQ goes down 400 points and the Dow Jones goes down 800 points, as it has been prone to do, say on Wednesday or something like that. This will mean that this is the money that I was paid, $319. Then all of a sudden, this number here will go green here. The 639 was a plus 150 or something like that. When this whole number, because I don't look at it as individual, I look at it as the whole thing here. When this whole number goes up to say $150 and I've made 50% of my money back, I'll close out every one of my options contracts here, make 150 and live to fight another day. Unless, of course, I do want to sell, say, JP Morgan at 133 or UPS at 182.50. I mean, these are all things I might opt to do, is just sell them and get my money back and then live to fight another day. And rolling these covered calls is something that I also believe that large hedge funds are doing right now at this moment. They didn't expect this market to pop. They probably sold short a lot of their equities. They're going to close out their short positions, roll them up in price and out in time. Doing that is actually going to boost the share price of all of these underlying equities, because I believe that they're doing the same thing that I'm doing. I think that the actual stocks are going to go up in price this week. I could be wrong, but I believe I'm thinking along the same lines they are. So they've probably been selling a lot of covered calls the same as I have, and they have to roll them up and out. And that's going to boost the share price. So right now, we're going to look at what Jim Cramer has to say about how to invest during a recession, and then I'll give you my thoughts on that as soon as he's done speaking.
Lots of people are worried. They think we're headed toward a recession. I totally get that. I like for you to think about what you don't stop doing and using in a recession, and that's a fabulous way to try to figure out what stocks to buy. We're raising rates. Fed's very worried about how hot the economy is. So what happens? People then say, recession, I better go to cash. Wrong. What you need to say to yourself is, recession. What companies have historically done well in a recession? Do you brush your teeth in a recession? Do you wash your hair, if you have some, in a recession? Absolutely. If you decide that you're going to stop doing those in a recession, then yeah, sure, don't buy Procter & Gamble. But Procter & Gamble, which just increased its dividend for, 60 years, does great in a recession. Coca-Cola. Do you know that sales don't go down in a recession? Beer goes up in a recession. So there's Constellation Brands. They make Modelo, Corona. Maybe you've had a Pacifico. When you go down those supermarket aisles, what are you buying no matter what? We're talking about things called staples. And staples are things that you need regardless of the economy. And that is what you're looking for.
And while I do agree a lot with what Jim Cramer had to say in that video, I do think we need to go into staples, but I don't think it has to be all staples that you get from a grocery store. A lot of staples would be a lot of your computer stocks like Microsoft and Apple and Google. Those are also staples. They've been largely beaten up, probably in large part because they've been sold off as part of a larger ETF, Triple Q's ETF sell-off, but also in some part because companies like Snapchat, for whatever reason, have a little earnings revision a month after they report, causing these stocks to sell off. But they are staples, make no mistake about that. Also, I believe that a large part of the lion's share of our downturn is behind us now. A lot of the spec stocks have been absolutely decimated. The low price to earnings the high price to earnings or no price to earnings stocks have been crushed. Crypto has crashed. Inflation is likely peaked. Interest rates are moving up and people seem to be more accepting of that. So I think that a lot of the bad news has been behind us. And I'm not predicting a bottom right now, but I'm just saying that the lion's share of our downward move is likely behind us. And that's my take on that. And so what am I going to do from here in the event that the market pops? Well, I'm just going to basically restructure my portfolio the way it used to be. I'm going to be 70% in equities, 30% in what I call cash, but that's actually equities that I'm just kind of like rotating through the market to try and make quick bucks where I see an opportunity as it arises. Sort of like if I had money left over, I might buy Amazon right now, but I don't have any money. But I have Amazon. All right, so if you got anything out of this video, please like, subscribe, hit that little notification bell. Until then, we'll see you next time. Have a good day. Bye.